Hey, good morning or good afternoon, everybody. Happy Tuesday. It's time for our webinar. We have a special webinar this morning, and our guest, Mark Mahaney from RBC Capital, is joining with us today. He's in the house. He'll be up here in just a couple of moments. And I want to thank all of you for joining with us this early session. We usually have our webinars on Thursdays, but this one's a special one because Mark's with us today, and I don't know if you guys don't know Mark. Mark Mahaney, he's the best number one internet analyst out there on the street, whether it's surveys or so forth, or results oriented. He's all about results, and if you've been following him for any period of time, you know what I'm talking about. He is par excellence, and we've had him on the webinar here a couple of times, and I'm absolutely thrilled and gracious to him for sharing some time and educating us on the internet names. And so I'm hoping, hopefully everybody can hear me okay. Can you give me a thumbs up that you guys can hear me? Fabulous. Good to see you, John. And so Mark's going to probably spend about a good 45 minutes with us today. We're going to bounce around a bunch of different areas, and I'm going to go ahead and bring him in right now. Hey, Mark, you there?
Yes, I am. Hey, Bob. Thanks for having me on.
Thank you, Mark. Thank you very much for being with us today, and it's wonderful to have you here, and this Thanksgiving week. And so let's kind of jump into it again. Mark is covers quite a range of internet names, and so I suppose let's jump in on number one, which would have to be, in my mind, it has to be Amazon. I mean, this company has been a killer for the past couple of years. Many have thought that they're going to crush retail. I think it's a little bit premature. Like Mark Twain said, that the death of, paraphrasing him, the death of retail is probably been exaggerated, but certainly this company has figured out ways to make profits in various areas. I mean, is it the sky's the limit for this company, or what do you think?
So, it is a stock that we have recommended on and on for over 10 years now. And I am willing to change ratings on stocks, but on some really core assets, we keep a pretty patient, long-term view on it, and I think that's worked, very well with Amazon. We I don't know if we coined the term, and we can't get the kind of FANG credit you got with FANG, but we've started using the term internet staples, consumer staples. Those are those companies that sell household products that people are absolutely certain they're going to keep using 5 and 10 years down the road, like Tide or oatmeal and Quaker Oats. And those are companies that trade at sometimes 20 to 25 times earnings, but they have very consistent kind of, low single-digit revenue growth and maybe mid to high single-digit earnings growth. Well, I've got a different set of group of companies, and Amazon's definitely in there. So is Google, by the way. So is Facebook, and arguably so is Netflix. So that's your FANG for you. But they're what I call internet staples. So I'm pretty certain that we'll be relying just as much on Amazon, probably actually a lot more in 3, 5, 10 years than we are today, but yet with secular tailwinds and with very good execution and with very large TAMs, this is not a 3% top line grower with high single digit earnings growth. This is a 20% top line grower. I look at these stocks and I'm just shocked, impressed, amazed by the consistency of the growth. So Amazon has done 20% retail revenue growth for 10 straight years. You can go back and check that. 10 straight years, quarter in and quarter out, and frankly, recently the growth rates have been higher than that. Most recent quarter was closer to 30%. Just like companies like Facebook have done 50% ad revenue growth for 18 straight quarters. That's 4.5 years. Netflix has done 35% global streaming revenue growth for 20 straight quarters. That's 5 years. Google's done 20% revenue growth for 31 straight quarters. That's almost 8 years. Just the consistency of the growth, says something about how well these companies are executing, but it also says something about how large their TAMs are. So if I just focus on Amazon just for a minute, to me, Amazon, if you're going to own one of these names and you're going to be pretty patient about it, and obviously get more aggressive on pullbacks or market rollovers, it would be Amazon. And I describe it as the tammiest of the large cap internet stocks. So what I mean by TAM is total addressable market. And this company is competing or going against three large TAMs. There's global retail, which is a $20 trillion market globally. Very hard to address, but Amazon is doing it. Second is cloud computing or enterprise software spend. That's a $1 trillion market. And then third, and this is a little bit of a sleeper category for Amazon, is at global advertising, which we think is on track to become a $1 trillion TAM, total addressable market. It's the only one of these companies that actually has $3 trillion TAMs, and they've obviously done very well in retailing. That's how most people know about Amazon. They are the global leader in cloud computing, so that's leading positions in $2 trillion TAMs. They're obviously not the leader in advertising, but we think that they can generate up to $10 billion in revenue within 10 years with high margins, great for Amazon, and high growth rates. So we like the positioning of Amazon. I think it's got one of the best management teams in the internet space and probably has the best management team. These are hard calls to make, but we like current fundamentals. We think valuation, look, we've seen Amazon be cheaper at times, but we're now in a cycle where you're starting to get material free cash flow. In this last quarter, they printed essentially what was trailing 12-month free cash flow of $8 billion. So there is a valuation argument that can be made here, and we like the fundamentals. So Bob, I like the fact that you started off with Amazon, because if you step back and not look 12 months but look 2 or 3 years out, it'd be our number one pick with a 12-month perspective. It's one of our top 3 longs.
Mark, do you think the Whole Foods acquisition was just a test for Amazon to see if they can add some incremental alpha and incremental earnings to their bottom line, and that maybe could be the tip of the iceberg of acquisitions for Amazon down the road?
I wonder about that. That's a $16 billion question, whatever the acquisition price was of Walmart. I'm sorry, Whole Foods, somewhere in that phrase, and it makes Amazon kind of passed the Rubicon there, and crossed the Rubicon, and you kind of wonder why they did it. And I think they did it for both offensive and defensive reasons. So I think that there would be categories where if they really felt they weren't able to gain traction as a pure online retailer, I think they've obviously now shown that they're willing to buy physical assets in order to expand. And, Amazon is a pretty patient company. I mean, they took 10 years to develop Amazon Fresh, 7 years solely in the Seattle area, 3 years also in other areas like parts of New York and in parts of LA and parts of San Francisco. And I think what they realized is they just couldn't get enough traction on their own, or they really needed to speed up that traction, and Whole Foods was the way to do it. So and I think the playbook here with Whole Foods is one, look at basic ways to just improve Whole Foods fundamentals. A lot of that's just simplifying, consolidating back-end procurement, but also lowering prices. Amazon's very much into the low price, large scale type of way of growing the business rather than high price, low scale. So you've already seen some of those changes. And then secondly, there are a lot of Prime customers at Amazon who could be incentivized to go shop at Whole Foods. There's probably 10, maybe 20 million Amazon Prime customers who would be logical Whole Foods customers but aren't currently, but you just incentivize them financially or however, and you'll increase the number of Whole Foods customers. And then third is part of the Amazon Whole Foods playbook is going to be integrating the back ends, really making the online ordering, delivery of groceries and even fresh meals or ready-to-cook meals, meal kits, make that seamless, and that'll take a couple of years of really hard logistical work to get done. But I think that's going to be done. That's the three parts of the Amazon Whole Foods playbook, and then we'll see what they do in other categories. I'll just give you one other point about Amazon. Amazon currently, the average Amazon household shops across about 15 categories when they shop on Amazon. To put some context around that, the average shopper that goes into Walmart, the physical stores, shops across over 80 categories. So I look at that as kind of a glass, quarter full or glass 1/10 full. I think that's an extremely bullish data point for Amazon. Now, it did also probably lead them to realize we need to expand how we get into all those other categories, and we may need physical distribution in order to do that. Obviously, they decided that was what they needed to do. So I wouldn't be surprised now to see them do that in other categories. And one that comes to mind is really high-end fashion retail. I think Amazon does a lot of footwear, apparel sales on its site, but I think most of those would be kind of, whatever you call them, ready to wear, kind of mid-level casual fashion. In order to get into the high-end fashion, I wonder if that's a place where they may find themselves, maybe not immediately, but 2 or 3 years down the road, buying into a physical presence, a physical store presence for high-end retail, high-end fashion retail.
I think what's also important, Mark, and I think you've touched on this once before, is the demographics of the shopper of Amazon. Now, my mom just turned 75. She's an avid shopper on Amazon. My daughter's 18, shops all the time on Amazon. I'm 50. I'm shopping all the time on Amazon. So there you go. You've got 3 different, generational type age groups that are doing the same thing and gravitating towards this. I think that's really one of the most powerful messages there for Amazon, don't you think?
I think that's a good point. One of the I've talked historically about having a 4M framework for looking at stocks, and I've talked about management teams, competitive moats, business models, and market opportunities. And 2 or 3 years ago, I wondered if I should add a 5th M, and that one being millennials. And you kind of want to. This is the biggest demographic cohort since the baby boomers, and you kind of want to, if they seem to be glomming onto something, catching onto something, really using something, that may be a really good investment opportunity. I think Netflix is a great millennial stock, but Amazon is too, and you wouldn't necessarily think about that. But I think just the ease of use, the functionality, the speed of delivery, the selection, the convenience, prices, etc. I think that's just as much of an appeal to millennials, and that kind of supports your point that you're seeing this company be relatively successful across a broad range of demos. So that's look, they don't really disclose too many of these numbers. We think that they've got something like 60 million Prime customers in the U.S. based on the survey work we've done over the years. Probably getting close to 100 million Prime customers worldwide. Those are that in itself is a very attractive demo, because we have found over time that those Prime customers are more engaged, they spend more, they shop more frequently, and they intend to shop more and more frequently with Amazon. Great customer base, highly loyal. It's kind of the big secret weapon, and it's no longer a secret that Amazon has versus other retailers.
So, I obviously, I know one of your other favorite names over here, as we skip around over here, is Netflix. And as I recall, the last time we talked, Mark, the HBO was just coming out with their competitive product, and I think it was like a day or two earlier, maybe it was that same day, and I think they were pricing it a bit higher than Netflix, as I recall. It could be wrong, and it was your.
No, you're right.
It was your charge that it's not going to matter what these guys do. There's always going to be competition, but Netflix has their footprint there, and they're not moving that foot. And that it was going to, it didn't really much matter. And then what did they do this summer? They managed to raise prices, and it still didn't throw people off the service. And I'll tell you, the content is fantastic. What do you think about Netflix here going into 18?
There's a long-term thesis on it, on Netflix, that over time we've become more and more convinced about, and we've flushed out more and more in our kind of quarterly reports that we publish on Netflix. We actually got another report coming out very shortly on Netflix based on survey work. This is a consumer front-end company, so you want to figure out what's happening in Netflix. You find a group of consumers, like a couple of thousand in the U.S., but also in multiple international markets, and you just track them over time, and that gives you a decent guess as to what's going to happen at Netflix. Anyway, we like Netflix. This is also one of our top 3 picks. I should mention now, Bob, that we go like this. Facebook's first for us, 12-month outlook, then Netflix, then Amazon. And I'm sure we'll cover Facebook next, or whenever you think is appropriate. But on Netflix, to me, the thesis is this: you've got a very large secular opportunity. I mean, we are living through this now. There are about 150 million paid streaming video subscribers worldwide. About 2/3 of those are on Netflix. There are about 1 billion paid cable TV subs worldwide. I think those numbers are going to meet. I think they're both going to get to 500, 600, 700 million. I.e., streaming is going to double, triple, quadruple from here. Wow. Cable TV subs are probably going to trim down. So, so one, I think there's a large secular growth opportunity. Secondly, Netflix is the global streaming leader. So they got, maybe have 5, 6, 7, 8 times as many subs as their closest competitor. And this is a business where scale matters. Whoever has the most subs generates the most revenue with which to buy more content, which then begets more subs, which begets more revenue, and you flywheel that thing. And so this is a scale business. Whoever has the most subs can buy the most content. That may be fair or maybe unfair, but that's the reality. And so Netflix is the global streaming leader, and it's in a business where scale matters. The third part of the Netflix long thesis here, and there's 6 elements to it, is I think they've proven profitability in the U.S., and they're just finally starting to prove it in international markets. That second one may be a surprise to people, but this will be the first year in which international will generate positive contribution profits for Netflix. I mean, these are difficult markets to build up. Before you get $1 single of revenue in any market, whether it's Portugal or Germany or South Korea, and they're launching in all of these markets, or they're in all of these markets, you got to spend tens of millions of dollars to buy the content rights for said market, and you got to spend tens of millions of dollars on marketing. And so it's very heavy table stakes business. The ante to get into streaming in any market is expensive. So, of course, when you launch a bunch of international markets, you're going to be in investment mode, loss mode for a while. But they're just starting to come out of that in international markets, and we'll see this profitability really ramp nicely. Fourth is we think this company's got global appeal. We see them now. They actually have more international subs than U.S. subs. That was also kind of a turning point this year in terms of the company's fundamentals and its stock price. So nice to see a company with global appeal. Fifth, we think they've got pricing power. We'll find out if they execute well on that. The price increases are going into effect now. But we did notice that when they raised fees last time, they actually showed no real slowdown in the number of net new subscriber adds. That's the very definition of pricing power. You raise prices and it doesn't impact the number of new subs you have. That means you have pricing power. And finally, kind of long term, we think this is an asset that's got well over $10 in earnings power. And I think that number actually within 5 years is more like $15, could be $16, something like that. You put a premium, 25 PE on that, something like that, and you can see yourself, your path to a $400 stock. I'm just saying I think there's a path here for the stock to double in the next 3 to 5 years, not in a year, but in 3 to 5 years, given its earnings power. That's the Netflix pitch.
That's amazing. Now, the one thing about Netflix that I appreciate, that I'm sure a lot of people who use it, is the fact that we're not bombarded with ads. I certainly hope they don't go to that model. I know that would be a little bit of incremental revenue for them, but I'm really hoping that they don't do that. Do you see that in the future at all, or no?
I think your point of view, Bob, is similar to what the company's point of view. I've seen Reed Hastings been asked this question numerous times by different investors, short-term, long-term investors. And I think his point is very similar to yours, which is that there is something unique about the Netflix value proposition, and you don't want to screw with that. Now, would there be some international markets that have very low GDPs per capita and where you're just not going to generate material subscription revenue, and where layering in advertising revenue could help? Possibly, but I think that's like 5 to 10 years down the road. I think you could, for anybody listening here, participating in this webcast that is either in the U.S. or in Western Europe, I think the chances of you seeing any advertisement on Netflix is 1% or less in the next 10 years.
That's good. All right, so let's jump around. I did have before I jump into the next one, Mark, I did have a question for you from Jim Cramer. Jim, I emailed him and asked and told him that I was going to be having you on, and I asked him if he wanted me to throw a question at you. And his question was, do you see, and now of course we've only talked about Amazon, Netflix, maybe if we could throw in Google or Facebook, do you see any of these benefiting if the government wins against AT&T? I know because this is all really fresh. I know
that's a great question. I'm not surprised it's a great question. I'm not sure I've thought through the funnel well enough. Let's see. I would think that I don't know. I would think that that's maybe a modest positive for a Netflix. And the spin on that would be, the logic flow on that would simply be, Netflix doesn't want to see too much consolidation amongst its suppliers, and suppliers would be content companies. Now, So something that stops big media mergers, or at least causes them to hold off, that may be a good thing. I don't know, Disney buying Fox, I think that a company like Netflix would prefer to deal with multiple different studios rather than one gigantic studio. So I guess that's the one thought that comes to mind. And then, I would say that it's a small thing, but that'd be an incremental positive for Netflix. In terms of the other companies, none of them, as far as I know, are going to do I don't see a major acquisition, at least in media technology, coming out for Google. That hasn't really been its MO. And for Facebook, outside of WhatsApp, that really hasn't been its MO. And I'm not sure what that asset is that they would want to buy out there. Okay, maybe a Snapchat, but I think they've already recreated Snapchat internally. So I don't think that that would be a negative factor on those companies. So that's the only derivative I can think of, which is that would be a modest positive incremental for Netflix. I would say that, just spinning really quickly, there are three major risks I think about with these large mega platform companies. First is always competition, and I think about these companies kind of swimming in each other's lanes, and Google doing more in cloud computing and Amazon doing more in advertising. So I think about that competitive risk. Secondly, I think about maturity. It's shocking how long these growth rates have stayed premium, and at a certain point, penetration rates are so high, the revenue bases are so high that the growth rates have to slow. I know that day is coming. I just don't know when. I would have probably said a few years ago that it'd be now, and it obviously hasn't occurred. So, what do I know? But anyway, I do worry about that risk at some point. And then third, I worry about, which, since you brought it up, government or regulatory risk. And I do think that Google is the company most in the crosshairs for regulators, as well as it should be, given its market, its very large market share. And I do focus on whether there would be some sort of regulatory legislative change that would negatively impact these companies' actual business models. It's hard to see near term. We've done some work on it. We published a report on Google's Android TAC risk, and we can go through that. But I do worry about regulatory government risks, just since you raised it.
Interesting. I know you one of the last times I saw you on CNBC, you talked about some surveys that you've done, and I know you do quite a few of them. I'm trying to remember which one exactly, but I know you had said something about where companies were willing to spend their ad dollars, and you said that Twitter was near the bottom. I think that's right. And
yes.
And I think that might have been in the summertime, Mark. I can't recall exactly, but it was probably summer, maybe the fall. And I think Snap, you said, was a little above them, but they weren't much higher. Do you see any trends changing in that way? And obviously, what we've seen, Twitter, they had a decent quarter. I laughed at somebody. They said, well, now that they can do 280 characters, now the stock should double, right? from $20 to $40, and I was just,
yeah.
But do you see anything improving here with Twitter, or is this just a facade here? And then maybe if Snap is a viable competitor for them?
So I wonder about that. We do surveys, you're right. We've done 10 of these semi-annually, so that's over the last 5 years. We do this in conjunction with Ad Age. It's about 1,300 advertising professionals, mostly in North America. I think this is the broadest survey work that's been done out there, and I found it to have been directionally very accurate. We've seen rising advertiser interest in Facebook over the years, and we still see rising interest in Google, even though that's been around forever. And that seems to have played out in both of those companies' fundamentals. Starting at the beginning of 2015, we saw a real cresting, or falling, I should say, in advertiser interest in Twitter, and that was a very sustained trend for a good solid year and a half. And we did see Twitter's ad revenue growth decelerate, and then decline. Well, that's the only large cap company advertising name that actually has a year-over-year decline in advertising revenue in a secular growth industry. That's a very negative tell. But in all fairness, what we've seen over the last 3 times that we've run the survey is more of a stabilization in advertiser interest. It's no longer getting worse. It seems to have stabilized advertiser interest in the Twitter platform. And there are things that Twitter is talking about doing more in terms of selling its ad inventory programmatically. They also, I'm a big product guy, I guess. What I mean by that is, the companies that have innovated most on their user experience, on their product, on their customer service, et cetera, long term, those have been, to simplify it all, those have been the winners. I mean, that's the difference between eBay and Amazon. The latter focused a lot more on improving the product experience. That's the big difference between Google and Yahoo. The latter focused a lot more on its product experience, and there's a lot of luck involved in all these companies. Anyway, with Twitter, we have a sell on it. We are going to be running very shortly, not our next advertiser survey, but our next user survey. This company has talked about seeing really nice improvement in its DAU, or daily average user trends. What I want to know is whether we can track that ourselves in our own user survey. So if we do, we've been very public about this. That would may cause us to get less destructive on the stock, because we have a sell rating on it now. So we've seen stabilization in the advertiser survey. I want to see what happens in the user survey. Snap, on the other hand, that's actually a recent downgrade of ours. We were pretty open-minded about that, and we have not had the right call. We initiated with a buy when the stock was at $24. It obviously got cut in half. We stuck with the buy and only recently downgraded the stock after what seemed to us like probably a good acknowledgement on the company's part that they needed to fundamentally revamp their product. I think that's actually a very healthy sign. It's the first part of a 12-step process, if you will, to turn around the company, improve the company. So that's a good thing long term. It doesn't mean you buy the stock near term. So we're going to have to watch and see whether they're able to really revamp the product and make it much more intuitive for a broader range of users. If they do that, and I love to see that kind of willingness to take those kind of product risks, hopefully they can execute on it well enough, then it maybe become an interesting asset to own, to buy on the when they come out of that product development funnel, tunnel, whatever it is.
Interesting. I know one of the groups in the internet space that's kind of near and dear to your heart is the online travel business with Priceline. It's really been consolidated in the last few years. You got really your big names are your Priceline, your Expedia, and your TripAdvisor, and then of course on the Chinese side you've got Ctrip, and then you've got the India one as well too. But for the first three, which I know you cover those, these stocks all got pasted last quarter, and I suspect maybe part of it had to do with the hurricanes from the third quarter. So but I think a couple of these companies, guided real conservative for this quarter and the quarter after next. I've always looked at these online travel companies, Mark, as a good leading indicator, not in just to the consumer, but into the business world and business travel. What do you think here in these guys? And do you think, I know Expedia is one of your favorite ones. What do you think about these guys?
I think the most interesting large cap internet stocks to do work on right now are Priceline and Expedia, precisely because they've become more volatile, precisely because they pulled back. I mean, I like Facebook, Amazon, Netflix, Google, but I can't say that any of them are really for sale right now. So you're kind of buying with the herd, which isn't necessarily a bad strategy, but there's no contrarian call to be made on those. Whereas Priceline and Expedia, they're definitely in dip mode, and the market is debating whether these are dips or sinkholes. And I've covered both of these companies since their IPOs, so that's over 20. That's almost 20 years now. With these names, there've been some dramatic changes with these businesses over time, but there's also been a heck of a lot of consistency. Both of these are high margin businesses that generate a lot of cash flow. They do return that cash flow to shareholders in terms of buybacks and even a dividend in the case of Expedia. They've been good growth assets, particularly Priceline. I think there's been a confluence of events recently that have caused investors to be uncertain about what to do with the stocks. I think hurricanes, as you mentioned, that was one factor. I think you've got new CEOs that are trying to put their imprint on each of these businesses, trying to get a little bit more aggressive in terms of investments. You've had hotels trying to reclaw back market share from some of these OTA channels, online travel agency channels. You've had the rise of this thing called Airbnb, which may be siphoning off some traffic, some revenue, some bookings, some profits from both of these names. But, I step back. I think particularly Priceline, so I'm going to switch on you a little bit. I think Priceline is actually the more interesting asset to buy here rather than Expedia. Comps will get easier for Priceline going into next year. They are in a process of disciplining, what I call disciplining their marketing channels. They use TripAdvisor. They use this company called Trivago that's also publicly traded. And, they generate about 25% of the revenue for both of those companies, which means they have a lot of leverage. They're exercising that leverage now to make sure those marketing channels are working for them. It's causing a near-term slowdown in Priceline's growth rate, but we think that growth rate can reaccelerate next year. And I think you still got a high-margin business with very good management team, very consistent growth, slowing, but very modestly slowing revenue growth, bookings growth, room night growth. And I think it's still one of the best ways to play kind of three broad secular trends, and I'll stop on Priceline. The three broad secular trends are obviously increasing adoption of internet for leisure travel bookings. About 40% of leisure travel bookings worldwide are done on the internet. That's asymptotically, inexorably going to rise to 70, 80, 90%, over the next 10 to 20 years. Secondly is the rise of kind of generational interest in experiential purchases rather than goods purchases. For some reason, these millennials don't like to buy products so much. I'm having a hard time getting my new 16-year-old to think about actually buying a car. He just would rather just use Uber or have mom or dad pick him up. So there's a win-win here if I can buy him a car, get him to buy a car. But anyway, what I find is that these younger millennials prefer the experiences, the travel, rather than the goods purchases. So there's kind of a broad secular trend there. And third is the rise of the emerging middle class in emerging markets. And the biggest travel outbound market in the world are the Chinese nationals traveling outside of China and going into other parts of Asia, North America, Europe, etc. And Priceline's a great play off of all three of those. On the last one, it has a investment in Ctrip, and it powers about half of Ctrip's China outbound hotel bookings. So they've got a really nice broad play against all three of those secular trends.
How about Open Table? Do you see them contributing much? I mean, that would obviously be a play on the consumer and the strength, and you can get a good view and forecast on what the consumer is doing. I know there's probably just a modest amount of incremental revenue, right?
Yeah, you're right. They acquired, Bob, you're right. The Priceline acquired Open Table for approximately $2 billion, and this was 2 to 3 years ago. It's been a small asset for them. I think they have found that they needed to do a lot more work than they'd originally realized. That there was a lot of legacy infrastructure at Open Table that needed to be updated. So that's it's a good asset on its own, and there are some synergies within Priceline. I think that's just work in progress, and as it comes out of being work in progress, it's a nice positive. It would be part of the Priceline investment thesis, but it would not be one of the top 3 or 4 reasons to own the stock. But it's a little bit of icing to the Priceline cake.
Let's talk about your number one stock, Mark, Facebook. They had a real good quarter. Actually, they've had really good quarters over here, and expanding their reach out there. I heard Mark Zuckerberg say that there's 6 billion people on the planet, and he's probably going to try to go after every single one of them. But this is being an all-time high, and you're right near an all-time high. I guess it hit that after earnings came out last in November. What do you see much more growth for this company, even with the competition out there?
Yeah, I do. Let me start off just thinking about valuation on this name. This is a name that trades at about 25 times GAAP earnings, which sounds like which is a premium multiple to the market. But this company gives you premium growth. They are going to do. We think they can sustain 30% plus earnings growth over the next 3 years, even with an appropriately aggressive investment outlook. The amount of dollars that they're spending against at least 3 priorities: making their network more secure, increasing their investments in video content, having more video content available on the Facebook Watch tab, which is just sort of rolling out now, if you will. And then the third one is more investments into artificial intelligence and machine learning. Anyway, despite that investment horizon, I think what I find interesting is this is a stock that trades at a discount to its growth rate. You don't normally see that, or you don't see that happen for too long. So I think it provides a heck of a lot of support for that valuation multiple, for the PE multiple, and then the stock can just work off of earnings growth and maybe a little bit of upwards multiple revisions. But you don't even need that. You can just off of that 30% earnings growth. I think the stock can work very nicely. Our survey work from the advertiser perspective still shows a rising percentage of advertisers want to increase their budget commitments to Facebook. To be specific about it, our last survey showed that 66% of current Facebook advertisers plan to increase their spend with Facebook, and it was something like 5% or less were planning to decrease. Like the skew has gotten even more positive. And then on the user side, we still see, even though this company has 2.2 billion users worldwide, we still see kind of mid-teens growth rate for this business. I mean, at some point that's got to slow down. They must have 75% of all internet users in the world who don't live in China must be on the Facebook network, given the size of their MAU base, their monthly average user base. But so that's got to slow down the growth. But anyway, they, it's something that's clearly shown a global appeal, high margin. This is the highest, most profitable business in the space. I mean, it's got higher margins than Google does. Frankly, its margins are almost 2x that of Google's. And this company is aggressive, is spending, is investing as quickly as they can. So, we like the position. The management team is good. And I guess what's going to be really new about Facebook? And that's always the question you have to ask about these all-time high stocks. Like, what's the new thing? And I think the new thing on this name would be the messaging assets that it owns, Facebook Messenger and WhatsApp, 2 billion plus user entities, utilities, platforms that generate zero in revenue to date. I think it's just a matter of time before they start monetizing those assets, and each of those could contribute a couple of billion in annual revenue over time. It's not too often you get an asset of this size that has still got two massively not under-monetized but unmonetized assets in its portfolio. It's one of the top reasons why we like Facebook. It's one of the top reasons why it's our top pick.
Well, you just made a comment there about the management team. I think that that Facebook's management team is probably one of the most underrated in the valley up there. And just a couple of leaders between Mark Zuckerberg and Sheryl Sandberg. You have two of the most premier people up there leading their company. I mean, that's, don't take anything away from Google and as well too up in the valley and some of these other companies, but I would put those two up against anybody in their business in their business any day, any time. How about you?
Yeah, I think that the management teams that have most proven themselves, and I try to be pretty careful about making these kind of calls. Amazon. Yeah. Facebook is in there, Google is in there, probably Netflix and Priceline, and maybe to some extent Expedia. Now, some of these teams have started to have kind of natural turnover in their management teams. Facebook, what do I want to see when we look at management teams? We want to see companies that can think a couple of pieces down the chessboard, that are willing to think long-term, that are willing to make multi-year bets and then get lucky or get the right bets. They are willing to make acquisitions. I think Facebook acquisition of Instagram will go down as one of the top M&A deals in technology history. Really? I think they bought that for $1 billion, and that thing, if it were to be on its own now, would probably be worth well north of $20 billion. That's a pretty damn good ROI. Call it a 20x ROI and a 2 to 3 year period, so you don't get that. So that says something about management skills or management's vision in realizing how Instagram could have been, how could have been successfully included. We'll see about WhatsApp, whether that acquisition really works out. That's going to take a couple of years to prove out one way or the other. But yeah, I like to see these companies that make good, smart, focus on product, focus on the consumer, focus less on competitors, and invest aggressively either organically or through acquisition in ongoing product innovation. That's been the key to success for names like Google and Amazon. They've also had a lot of luck along the way, and Facebook seems to be in that same path.
One of the smaller companies that we talked about before we got started, Mark, was one that has my interest. It's Yelp, and I know that's one that you've covered for quite a while. And they had, when their earnings came out, they were fairly decent. I think they guided a little bit conservatively into the quarter, and they had run up. Admittedly, they had a really great quarter in the second quarter and gapped up and has been holding up there in the high 40s. Do you see some room for this company some runway here for this company to take off with, or are they going to? Or they have some limitations to what they can offer people, for the consumer?
Let's see. So Yelp is it's actually currently our top small cap pick in a mid small cap range. Now, should have mentioned this earlier. Top picks for us in the small cap space would be first Yelp, second TrueCar, and third Zillow. Those are all small mid cap names. Yelp is one where we've not been I tend to be more tactical, not necessarily accurately either, but more tactical with mid-small cap names. I think oftentimes they're mid-small cap for a reason. Either they don't have the large addressable markets of some of the large cap names, business models aren't as attractive. There's just a lot more competitive risk for any mid-small cap name. If you think about investment risk, you should almost always put in Amazon or Facebook or Google as one of those risks. And that's the case with Yelp. Not that Amazon or Facebook are competitors, but Google is, it's a source of traffic for them, but it also is a competing source that consumers can find and businesses can, other ways to market to each other, connect with each other, et cetera. So I do worry about the competitive risk with Yelp, but we like the stock here. We think that this is one that had recently pulled back. I think there's a little bit of misunderstanding about the sale that they had of a company called E24 to Grubhub, and I think when they sold that asset, it did reduce their revenue outlook, and I think people didn't quite understand how that was gonna play out in the guidance. And once they did that, I think the stock, when people realized that, I think you found a little bit more stabilization and support in the stock. We think that consumer metrics here have generally been, very consistent in terms of, internet users or web users or app unique device users. We've seen nice growth in their paid advertising accounts. I think they've reached escape velocity in the U.S. in terms of not needing materially reducing their Google dependency. And we think there's a nice, really fragmented local advertising market that this company can tap into. Current valuation, it's around 15 times EBITDA. That's not cheap, but I think that's pretty reasonable given what I think is a 30%, EBITDA growth outlook for this name. And then the last thing I'd mention is they've got one small product called Request a Quote, RAQ, Request a Quote. And I think that's really helped expand this company from just an advertising platform to an advertising and transactions platform. So small businesses can use Yelp not only to let local consumers know about their services, but to actually, let local consumers book their services, whether that's, landscapers, whether it's dentists, whether it's, pet care, providers, pest, exterminators, all the local businesses that make up, the economy. All of those can look at Yelp as a way not only to advertise, but also as to actually, contract consumers, and therefore it's become a more useful platform for both small businesses and consumers. That makes us like Yelp fundamentally, and where the valuation is here, we also like the stock.
We haven't talked about Google yet, and Google Alphabet, and this is one that's been quite intriguing. It was one of your absolute top names a couple of years ago. I know it's not in the top three right now, but I suspect that it won't take much longer. I know we talked before we got started. I asked you about what we thought about Waymo. You said that's probably down the road, some years down the road, and things are a little bit foggy right there. But as far as Google is concerned, advertising, you did say earlier that you thought that government regulation risk is probably highest with Google here. How is that? And obviously they've been fined from the some European zone. So I mean, what do you think for their opportunity, at least going into 2018? Another company with a great management team.
I think the Google story is going to be, I think there's kind of 3 or 4 swing factors on Google are Can they sustain this 20% growth that they've done for almost 8 years in their core advertising business? We think they can. We think they've well gone through this kind of mobile tsunami or this massive shift in search activity going from desktops to now the vast majority of searches are done off mobile devices. And I think that they've kind of gone through that and been able to maintain their revenue growth, so that shows that they can survive platform shifts. But anyway, they need to continue the swing factors on a stock, which we think largely break their way, but some may not. The 5 swing factors are: can they sustain that 20% revenue growth? We think they can. Can they sustain the margins in their core business, their core Google business? We think they can. There's some scale advantages. She's no longer the new CFO in town. Ruth Pratt's been there for almost 2 years now, but I think that there's a multi-year plan she had for wringing kind of investment efficiencies. I wouldn't call them cost efficiencies, but investment efficiencies out of the business. I think she's doing that. The third is, the third swing factor on a stock is, can they stabilize what's called their TAC costs or traffic acquisition costs, the amount that they pay out to Apple and Samsung. And that's an unknown for us. And the market is concerned that those costs will keep rising as they have aggressively over the last year and a half. Our guess is that those costs start stabilizing next year, so that could be a new incremental catalyst. The fourth factor on the stock, swing factor on the stock, is what about these share buybacks? With $100 billion in cash, you should be able to return some of that to shareholders, and I would expect them to do that. I'm a little disappointed that they didn't do any this last quarter, but I would expect the pattern since Ruth has been CEO is most quarters they have been returning cash to shareholders. I would expect them to do that. I think that'd be a positive catalyst for the stock. And the fifth catalyst or the swing factor on the stock is, what about these other bets? That's in Waymo, that's in life sciences. Can they show any signs of life out of that? Pardon the pun. And what I mean by that is they've lost $3.5 to $4 billion a year from these other bets categories. Can they actually show that they can generate some positive metrics and some real revenue and potential profits out of those investments? And I don't know, and the market doesn't know, and Google probably doesn't know, but I don't think that's factored in. If there's any sign of life there, I think that'd be considered a positive catalyst, because I think overall the market is kind of agnostic on whether there's really value there. I'd be surprised if the company that can create arguably one of the two leading operating systems for autonomous vehicle driving, that company should be worth a heck of a lot, but we may not be able to really get a beeline on that valuation for 5 years from now or something like that. But when that time comes, and if Google is one of the winners, that's not priced in the Google shares. You want to own Google in advance of that market, eye-opening event. I just don't know when that event is, but I think probably that event is going to occur within the next 5 years.
So, Mark, about 10 days ago, Alibaba had their biggest sales day ever, Singles Day, and for the third year in a row, they shattered records. A lot of people don't remember. I was saying, one of the big reasons why Amazon did so well in the quarter, because they had their Amazon Prime Day in July, and that was contained in the third quarter. So they had those big sales. I think it was July 12th. So going back to Alibaba here for a second. I mean, this stock has absolutely crushed it with sales. Obviously, they're enormous in China. They're at a new all-time high today. And do you see more growth for this company down the road?
For Alibaba, yeah. Now we tend to focus less on it. It's almost like a tracking stock for me. I.e., I just track it rather than trying to call it. And we do have an outperform rating on it. I try to be pretty upfront with people that we don't have the resources to really track how well they're doing in China itself. I just look at the P&L that they print. We go through their financial filings. It's just harder for us to do kind of core research, core survey work. We can run all the analytics we need to, though, on the P&L. And so we have a buy rating. It's without the kind of the proprietary research conviction that we have in some of the other names that we know better and can know better, like an Amazon or a Netflix or a Facebook or a Google. But Alibaba is just a fascinating company, and I love to see all the different innovations that they're doing, the way they're branching out. I mean, there's some ways that they're similar to Google and Amazon, but there are many ways in which they're very different. And but versus that kind of growth, versus that earnings power, power versus the business model. We think valuation there is eminently reasonable. It's not it wouldn't be one of our top 3 buys, but it's been a consistent buy for us since its IPO. I know we had some choppy period around that IPO, but for the patient investor, it has generated a nice return, and I don't see why that wouldn't be the case also going forwards over the next 2 to 3 years.
Interesting. So I know we're kind of backing up against it, Mark. It's almost 10 o'clock, but I did want to finish up with a question for you that we talked about when we first got started here, and it's about Bitcoin. And I know that's not in your wheelhouse here, but I think that we all have to keep our eyes open to what's happening over here and the influence that this Bitcoin is having. And no doubt, I suspect if it hasn't already, it'll probably have some influence on the names that you cover. What's your spin on that thing? I know it's really sort of early and there's a lot of cloudiness right now going on, but how is that going to play out in some of the names that you cover?
Well, let's see. I don't know about Bitcoin itself, but I think that the cryptocurrency trend is and the blockchain technology that underlies it, I think those are 2 very sustainable trends, but I'm a little out of my wheelhouse on that. Now, whether the right way to play those trends is to buy Bitcoin or not, I don't know. I feel less confident about that. I like the race. I'm not sure about the right horse, and I almost feel like I'd rather not have to make a bet on the horse, or maybe the way to do it is I think a lot of people I think I'm going to butcher this analogy, but I think a lot of people will go to watch this race, and so that means that there'll be a lot of money wagered, and I'd like to bet on a couple of the horses or spread the bet. So I don't know whether Bitcoin is the right way to do it, but the amount of public investor interest I've seen, an industry investment in cryptocurrencies and in blockchain technology tells me that there's probably a really substantial opportunity there. I'm not convinced that Bitcoin is the best way to invest in it, but the underlying, the underlying race, the underlying technology, and the underlying end markets, I think those are extremely attractive. Whether that's an opportunity for Google or Amazon because of the payments businesses that they already are in, yeah, I would think that's a distinct opportunity for them. Although, frankly, I haven't heard any specific initiatives that either company has done, but that's kind of in the watch this space mode for me. My colleague here, Dan Perlin, is a big bull on PayPal, and so that would be kind of and I do co-cover that with him, although he's the lead analyst on it. That'd be one where it'd be more closer to the vest, stick to the knitting, kind of good, solid investment, recommendation idea, PayPal.
Bitcoin reminds me of the B2B space back in the late 90s, Mark, where there's a lot of companies who were kind of avoiding it for the longest period of time, or even, .coms. And they, the bigger companies just, had to make an investment by default because they just had to be there because they didn't want to be, taken out and dragged onto the carpet because they weren't part of the quote unquote the new revolution. I don't know if if Bitcoin's going to end the same way as those .com names did back in the late 90s, early 2000s, but it may be just one of those things that these big companies like Amazon and even Apple or Google, they're just going to throw an investment in there just because they have to say they did it. I know Cisco did that quite a bit back in the day, and a lot of those investments went bustola, but and we'll see how that goes. But anyway, well, listen, Mark, I know it's running kind of late, about 9:55 over here, and I want to thank you so much for spending a great amount of time with everybody, and your analysis is always spot on and brilliant, and I'm thrilled and delighted to have you on here.
And vice versa, Bob. Very much enjoyed doing these with you. Thank you to you, and wishing you and everybody else a wonderful and happy Thanksgiving.
Thank you, Mark. Have a happy Thanksgiving to you and your family, and a good holiday. And everybody else, I'll have the webinar replay up on the website a little bit later on today. And thank you all for joining with me and Mark. And wish you and your families all a very happy Thanksgiving. Thanks again, Mark.